Welcome back to The Appointment. My guest is the Managing Director and CEO of Bank of Baroda, Mr. Jayakumar. Well, Mr. Jayakumar, growth. What are your deposits and your advances in the 9-month period have shown a decline? What are your forecasts for the full year, both for advances and deposits, and more importantly for FY17?
Well, the fact that the end of period numbers show a decline is not reflective of the real position. As you know, sometimes in March the balance sheets get elevated. On an average basis, we have done quite well. For example, a current and savings account has grown on an average by 12%, which I think is a tad above the industry growth rate. So we, in a sense, we've got a little bit higher on the market share of the total current and savings account. When we look at our assets, we have still clocked a 7% growth or thereabouts on an average basis. Going forward, we are going to start reporting numbers on an average basis because we earn from average and not from the month end. And also we want to take away any incentives for managers to suggest to customers to put more money in the current account towards the end of the day and fund it from drawdown of their overdraft facilities. All that will not happen. So we have to look at the averages, and on the averages, on the balance, I think it's been a pretty good job.
Well, actually, instead of getting these granular numbers, let me straight away come to the margins. Your margins stand at 2.21. Where do you see it in FY17?
Okay, let me explain to you that this 2.21 has got certain amount of, within quotes, one-timers. When you take a provision, move about 15,000 crores of assets into NPA, you have a significant reversal.
Yes.
And for that quarter, these assets don't earn any money as well. So effectively, on an average, we lose 6 months interest. Adjusted for that, I think our numbers are pretty much the same. Now, you move the ratios, you move the NIM through a organized process. What we have done is basically we have computed the NIM to risk for every customer of ours. So you can think about it as some kind of a 4 squares. On one side you have high risk and low risk, and high NIM and low NIM. And having mapped the customers, we know the customers whom we have to do more business with to improve the NIM. And that is going to come from employee accounts, financing the dealers, the chain, the supply chain, doing more letter of credit and transaction accounts. And incidentally, we are strengthening the transaction team from getting people from outside who are joining us. So I think that it has to be a calibrated strategy. It is an account level strategy. It is all about details and then getting this done at a granular level. So I think the NIMs will improve. Medium term, which is 3 years from today, I would think we're looking at a 3.5% on the NIM. I think it will happen.
Okay, so immediately that's 3 years. So if I were to look at 1/3 every year this in FY17 itself, you should be closer to 3%.
We should. It is also running down some of the assets which are not earning us the required NIM. We should be able to lay them off. There are the syndicated debts which we have to. So it's going to happen through a combination. It's also going to be about returning. Somehow exiting from portfolios which are giving us low NIM margin. So I don't want to put a number here, but you clearly will see improvement from this point of time.
You said that you are expecting to reach FY14 profit next year.
Well, what I
FY15 profit.
What I said was we were not giving any guidance. I was saying that if you were to take a scenario and play it out, then you could say that there's a very high likelihood that the company should reach the FY14 number in terms of pre-tax, pre-provision numbers. And given that, which is probably about 9,500 crores, I said that even if there was a significant deterioration in our portfolio going forward, it still would not result in having any impact on the capital. And therefore we'll continue to have a good capital ratio, which is why we completely discount the likelihood of dilution of equity share at this point of time. And for a foreseeable future, I think when I say foreseeable, you can take a period of 18 months to 36 months. I don't think we need equity capital. There could be a scenario we grow very well and we may want capital, but that's a good problem to face. The government has been very nice to us and has asked us whether we would like to get capitalized, more recapitalization. And we have told the government that Bank of Baroda does not require any further capital, and we should be kept out of any capital planning that is meant for the bank. So clearly we don't see any dilution. We don't need the support in the form of additional equity, and we are well placed to serve our customers, support their growth, and still keep the capital adequacy at the current levels.
Okay. Well, 18 to 36 months, you even with Basel III, you don't think you will need?
Right now, so there are a bunch of things that are happening over here. One is focusing on the efficiency, and it works in multiple ways. Exiting certain classes of assets, which, as I mentioned to you, does not have a customer relationship angle to it. That's point number one. So with that, and we're expecting to use that to fund customer asset growth. So you may still come back and say, I don't see an increase in the balance sheet, but what is happening below is getting substituted with customers replacing, assets that have been purchased from the market, where the customer does not even know probably that we are holding the paper. So the absolute quality of the income will increase because it triggers more opportunity to interact with the customer.
Okay.
So that's one part of the story. The second part of the story is the bank has got a fair amount of financial assets which have not been monetized, and there is an opportunity to monetize them. In that monetization, I'm not including our ownership in the subsidiaries. I'm talking about a number of investments that have been paid over a period of time. We have some gains in the foreign currency which would also at some point of time flow into the balance sheet. So you could say that we have a fair amount of mark-to-market gains, or potentially mark-to-market gains that we can take in, and that is also accretion to capital. So put all of these things together, the capital adequacy ratio is there, and we could easily support a 20% growth next year without dilution of the capital. And that is because we are now getting better at dealing with inefficiencies, getting better at moving towards higher grade customers on whom the capital call is less. We did an exercise of our balance sheet, and we found that there are inefficiencies in the form of lines of credit given not cancelled, which are no longer required, large lines of credit the customer is never going to access, and a variety of things. As we clean up, we are finding we should be able to release about 50 basis points of capital, 0.5. And then we have a large number of banks outside of India, and if you go on a consolidated basis, which is the right way to look at it, we get another 50 basis point pick up on the capital adequacy ratio. Put all of these things together, you're growing without necessarily calling significantly on the capital, even excluding any potential generation of revenues, profits. We should be quite well on the capital adequacy ratio. So it's about efficiency, efficiency, and efficiency.
On that note, we are back with some questions to Mr. Jayakumar. He's a relative outsider to the public sector banking system. So some questions on what he has picked up in terms of the quality of the public sector banking sector. In a minute with Mr. Jayakumar.